Okay, I'm excited about this week's episode of Rethink Real Estate as it's about tax and accounting advice. However, this is a disclaimer for the attorneys. Before making any tax or accounting decisions, it's important to seek professional guidance. The information provided here is intended for educational purposes only and should not replace the advice of a personalized qualified professional. Taxes and accounting are a complicated situation and individual circumstances vary, so it's important to find a qualified accountant or tax preparer who can provide personalized advice. As part of their service, they can evaluate your individual needs and help develop a strategy to minimize taxes and maximize returns. Additionally, remember to keep careful records, meet deadlines, and pay your taxes on time. Failure to do so can lead to fines and penalties. Enjoy the episode, team. Welcome to Rethink Real Estate. My name is Ben Brady, and this is a real estate podcast aimed to deliver sales strategies, marketing tips, and business insights from industry experts and myself to build a listing-focused business for the future. Let's get into it. Well, ladies and gentlemen, welcome to another episode of Rethink Real Estate. Today, we have a special guest. First of all, Anne has a very close relationship to me, and what I mean by that, when I say close, to my financial position and absolutely helping me dig out of the taxation hole that I can create for myself on a regular basis. Anne, welcome to the podcast.
Hey, Ben. Thank you for having me.
No problem at all. So this is a topic that I think that we would get requested many, many times over when it comes to agents, not only when it comes to their individual tax situations, the structures of which ultimately they should have as a self-employed essential person. I was saying to you before we jumped onto the podcast today is that one of the number one Googled searches at the moment in the real estate community is real estate agent tax advice or realtor tax advice. So this comes at a very opportune time as we draw closer to everybody having to have their tax situation buttoned up. They should have a little bit of an idea of it before now, but ultimately, what is the deadline? I know that I should know this, but what is the deadline to have everything filed?
Yeah, so I like to call it or say to my clients, winter is coming. Winter is coming. So if you have a flow-through entity, so that's going to be a partnership or an S corporation, your taxes are due March 15th.
Uh-huh.
And then as an individual, that's April 15th. Granted, if you extend, then they are due September 15th for entities and October 15th for you personally.
Right. Okay, so the thing that without giving you the introduction I should have at the very beginning, guys, Anne St. Germain is somebody that when I say I hold her in high esteem, it is a understatement, considering that we'll talk about a little bit of our journey from a financial perspective of how we got to meet Anne, but essentially I had to get rid of an accountant because they weren't creative enough in order to help us through our situation, us being, having visas in play, and I can't remember how many entities we have now and all of that different stuff. You are somebody that is far more creative and far more knowledgeable than most of the people that I've ever worked with in North America. You can help anybody within North America, whether that be Canada, whether that be any of the states. Either way, if you have a question, I would implore you guys to look into the show notes, reach out to Anne on the website that you'll see in the show notes as well. We'll make sure we have her email address, her contact number, it'll all be there. But the thing that I have found in personal experience, and I'd love to get your comment on this, is that when it comes to taxation, just in general, finding the right partnership with the right CPA, it just makes this world of difference. And there's a level of comfort that you give us, knowing that you have our back, knowing that you'll reach out to us when we need to think about things, because my brain doesn't function this way. And I think I'm speaking on behalf of 99.999% of realtors that are listening, or anybody in any industry that's listening. Their mind doesn't function that way. How is it that you've come to be so good at thinking about others, because you've got such a large client basis? How have you gotten over the years that client relationship? How have you seen that develop for you?
Good question, Ben. So, tax law is not inherent, right? I had somebody tell me once, like, why would I know that? You just wouldn't, unless that's what you do for a living. And that's what I live, eat, breathe. It's a practice just like anything else. And I love what I do. I mean, of course, like any job, sometimes it's just a job, but no, I truly love what I do. And so I get excited because I have a relationship with my clients to be able to reach out to them and be like, oh my God, guess what? And so for me, that's one of my favorite elements of what I do is the planning, is the anticipation, all of these moves and structurings that we can do ahead of time and see the win, right? Because your
Yeah.
win is my win. At some point,
Yeah.
it really does become. I think, Ben, I told you when we first met, I'm like, tell me how close you want me to get. I will wear your underwear on my head if that's what we need. And that's how I am. I'm a relationship person, just naturally. So I like to dig in deep. And the more I know and the more we talk about, the more information I have to navigate what we can do, in your tax compliance world and structuring and how we can move, our widgets from here to here or whatever. So that's how it goes.
Yeah.
So it's my job. My job is to watch your blind spots.
Yeah, no, and that's certainly something that we've felt has happened. And how do you know that you might be in a relationship? And I say relationship loosely, a partnership, a partnership with a CPA that it's probably time for a refresh. Like I had to come to my own conclusion of that just because I actually brought something to my old accountant, my old CPA to say, should I be doing this? He's like, oh, that's a good idea, and that was a red flag for me.
Well, I like to say, first of all, it's good that your CPA be younger than you, if at all possible. They need to outlive you because when you
Yeah,
die, someone's got to take care of your estate and your property,
yeah,
what's going on. But besides that, um, your relationship with your CPA, I think it's a lot of gut feeling, but also, when CPAs start to get older, oftentimes, you become stagnant, right? You're just not as excited as you used to be when you're young blood. But, there are those that are going after it. But I think, really it's an individual case by case basis. But if you start to feel like you did, Ben, like if you're bringing things to them and saying, hey, what about this? Then it might be time to look otherwise. I mean, just because you want your CPA to be anticipating for you, right?
yeah.
It's a theory for me. It's sort of more of a principle that I'm anticipating for you because I'm watching your blind spots. That's not what you do well. That's what I do well.
Yeah, it's a good point when it comes to the factors of blind spots, because there are things that you have mentioned to me that I just didn't even know that I needed to be thinking about. But also, and we'll break a few of them down today in perspective to retirement and all of those different things. But I want to start in a particular place here, Anne, and just sort of go through the cycle of realtors, because that's the main audience that we're going to be speaking to, is realtors that are out there. And if you have a look at the real estate structure, it's an independent contractor structure where ultimately a commission check comes in, the brokerage gets that commission check, the brokerage takes their portion of that commission check, and then the remainder of that commission check ultimately is then sent out to the agent. Now, that is either individually sent out to them with, say, Ben Brady on the check or whatever name that it is from them individually, or it is then sent to their corporation or LLC. But I have to admit, with the most of the agents that we operate with, they simply just get a 1099 at the end of the year from the brokerage. A lot of them don't have corporations or LLCs. They're not really taking advantage of that. So I wanted to start off with asking you the question of, what is the difference between, like, them getting it individually and getting a 1099, having a corporation or LLC that then they get paid? What is the difference between the two of those?
Uh, I would say the most simple way to consider it is the difference between the two is how much tax you're going to pay, right? You're going to pay a lot more tax if you're just getting it a 1099 direct to your name, your social security number, and you're putting it on your personal return as just a Schedule C business.
Right.
Versus if you're getting it into your entity, your LLC or your S corporation, there are more moves to make there as far as how we're going to be able to reduce your tax, what you can deduct, and let's not forget, personal and limited liability with the entities, and that's what they offer, which is always very important in the business world because you never know.
Yeah. Yeah, so give us an example of I guess that the moves that can be made. Like, if I'm going to make a decision, like, I'm Ben Brady, I'm a licensed realtor, I don't have a corporation or LLC. how do I know which one that I need to set up? Because there's C Corp, there's S Corp, there's LLC. Which ones are better for me based on my situation, obviously?
Right. So based on your situation, Ben, where you don't really carry real assets like properties and whatnot for the most part, right? Your activity is a lot more of, in the auction world, et cetera. I mean,
Commission
notwithstanding your
driven.
9,000 different activities that you're in, for the most part, right? It's commission based. And so an S corporation is really sort of what I consider the Ferrari right now of, the tax entity structure. And the reason I say that is a very simple example is if you, Ben, got this 1099 and you just put it on your personal return as a Schedule
Hmm.
C, you'd
Hmm.
basically be paying tax on that whole whopping amount, right? Versus if we're going to put it in an S corporation, you give it to the company can turn around and pay you a wage. So you've immediately decreased your taxable income, also paid taxes in, and then you can bring in employees and whatnot. That right there alone is one of the biggest, differences between an S corp, an LLC, and an individual. Because in LLCs and a personal return like a Schedule C, you can't pay yourself.
Right. So just to confirm that, so I'm a realtor. I open up an LLC. I can't pay myself a W-2 wage.
That's correct.
Right. Okay. So that makes a huge difference in then retirement contributions and everything along those lines, which we can talk about later. But is that right?
No, indeed, because retirement contributions, when you are a self-employed individual, um,
Hmm.
have to do with your earned income. So those are
Hmm.
still calculated, but they're calculated based on your earned income, and you're still paying self-employment tax. But no, it does not change that element of it
Right.
as far as retirement
I got it.
goes. Yes.
So talk to me. So S Corp. I've got the Ferrari. Okay, why does a C corporation exist? Like I just don't understand that. Like there's not like I know that in the venture capital world, or if you're going out and raising funds, they basically require you to be a C corp based on how the tax passes through. I believe it is. Could you explain why a C corporation actually exists? And I know that it's irrelevant maybe to our audience, but what's the point of it?
Oh, there are elements of a C corporation that are beneficial besides, of course, the flat tax rate. But
Hmm.
again, you've got double taxation, which means the corporation pays tax. And then if you want to take money out of the corporation and a dividend, then you would have to pay yourself again. There are times, for instance, let's say you just have a ton of cash and you don't mind letting it sit in the company, you could accumulate it that way. And then eventually it would make sense to pull it out because you'd be, essentially pulling it out your retained earnings at a very low tax rate, in the dividend world. But again, it's just not something that, at this point, big companies are doing the corporation.
Right. That's right. So I guess that moving through this is the biggest question that everybody always has is that the deductions. Okay, do we call them deductions? Do we call them write-offs? What's the correct vernacular for this?
There's nothing correct. I mean, if you're going like straight tax law, then you would say a deduction. Right.
Right.
It doesn't
Okay.
matter. Let's
All right.
expense
Yeah.
it.
Yeah.
Let's write it off, whatever.
There you go. Expense write-off, whatever we like. All right. This is the exciting part. Everybody's always. It's funny. The other day, I'm sitting there with Justin Green, who works with the Harcourts Network. He's one of our best performers at the Green Group. Anne helps Justin out as well, and Anne helps us with a property that Justin and I own, and we're sitting there. And Justin, so this is my first question. So Justin, we're at dinner, and we're there actually discussing. We were at a work dinner. It was a work dinner indeed. I pick up the check and I pay with my credit card. It's my work credit card, but then I get the receipt because I log the receipt with Kelly in Expensify and all that type of stuff. And Justin's like, why have you getting the receipt? Do you keep records for yourself? I'm like, no, I've got to get it because you can't write off alcohol or something along those lines. I think Kelly told me, and he's like, no, like you just got the statement. I don't even collect the receipt. I'm like, so you just provide the statement? He's like, yeah. Like, so first thing, just settle an argument between him and I. I'm like, no, you've got to keep the receipt. You've got to put the receipt in there. Like, that's just good practice. And anyway, him and I squabbled back and forth on it. What's your point of view on that, Anne?
I think you're doing too much work, Ben.
Great.
Justin, you owe me. Justin's more right. You just need a statement to prove it. Now, if it were a cash transaction, then you'd want to save a receipt so you could prove it, right? Because cash is just like smoke in the air, really, honestly, right? That's why people love it so much. But yeah, you're trying too hard.
Right. So talk.
Nice. Yes.
Talk to me about Venmo then. You just brought up cash. Venmo, like we have a gentleman who does a lot of work around some properties for us and like does some work around the office for us, and we Venmo him. And Justin said, well, he knows the guy. Justin's like, we'll just 1099 him at the end of the year then, like from your Venmo statement. Is that correct?
Yeah. So if you're paying a guy and it's non-employee compensation and it's an individual, people often get this messed up. It has to be an individual or an LLC. You don't issue 1099s to an SCorp or CCorp, right?
Okay.
So if you are paying that person non-employee compensation, of course, all your lawyers, you got to 1099 them. Anything over $600, you got to let the IRS know. They want to know, right? Because otherwise, everybody that's getting paid cash gets away with paying zero tax.
Yep. Yeah, that's right. So at the end of the year, so I would just, as an individual, I'd just basically print my statement out that I've sent him all of that money, and then ultimately I give it to you and you 1099 him. Is that right? Or
that is correct. Yeah.
Right. Okay. So that's another, like this, folks, as much as we're trying to add value for the podcast, this is really good for me as well. Even though I guarantee that Anne's already been through this with me 5 or 6 times, it's still, my muscle memory isn't quite there when it comes to tax law. And as Anne said in the very beginning, nor should it be. That's where she's got my blind spots covered. So we're good here. So let's talk about some other deductions and some expenses. Is that home office is one that I have seen a lot of people overcomplicate in the past. Now, that said, is that there's a great deal of realtors that have home offices, legit home offices, not the ones that are just made up in order to benefit from a tax perspective. That I would say that the workforce, probably 70% of it works from home more than they do out of a physical space. So how does the deduction from the home office perspective work?
I can answer that several different ways.
Okay.
I would say some of it has to do with your level of risk tolerance, potentially.
Okay.
But for instance, since COVID, don't we all work from home?
Exactly.
My dog is in the background right here, right? No, no, but we all work from home. And if we're using this space and if we're bringing in clients or we spend our time here, I am of the theory that I am not going to use the IRS mini calculation with the special form. I can't remember the name of it right now. I am going to incorporate it into my books as my straight QuickBooks, my property taxes. I'm going to take a portion of that. I'm going to take a portion of my maintenance, my gardener, all that type of stuff. And I would set a specific allocation amount, right? And you stick to it and you document it. As long as you do that, you're going to be safe, right?
Yeah.
Want to get too aggressive? You can. That's what I'm talking about with risk tolerance. If you're terrified, which you shouldn't be, the IRS, they're just humans like us, and most of them don't have degrees or CPAs, by the way.
There you go. I didn't know that.
Yeah, that's true. So, if you do it by the book because you are, you want to really stick to it, the way that they suggest to deduct a home office, it's not a rule, right? It doesn't say you must do it this way, but there is the form, right? Where you say, okay, and Ben, we've gone through this. You've got, this space or your off property bungalow. What do you call it?
It's a studio. Like, so we've got like a separate studio to the house. Like it's like whatever percentage of the house it is, but it is completely separate to the house, and it is a working studio, which ultimately is our office. So again, so that portion, so we measure it out and it's X amount of square footage versus the overall square footage of the home.
That's
so say it's Yeah, so that's the percentage that then ultimately the property taxes, the gardener, the pool guy, all that type of stuff.
The power, the utilities, right? Your trash, all that type of stuff. Yeah.
Now, the other part of this as well, and that is there the same cap to what can be written off as what there is to property tax? I think the property tax is 12%. Oh, sorry, up to $12,000 can be written off in your primary residence of property tax. Is there a certain cap on your home office?
So I'm not following what your thought process is there, but I have an idea what you might be thinking.
Okay, please go for it.
So go back to 2017, right? When we enacted
Yeah.
the TCJA, one of the biggest uproars for us coastal states was the limit on your personal return for things like state taxes, property taxes, your vehicle license fees. All of that was limited to a $10,000 deduction, right?
Ah,
So that's a great workaround. If you have property taxes, you're going to be limited, right? So a way to take advantage of that deduction still is by using a portion of it on your businesses for your business element of the property tax.
got it. Yeah, you're absolutely exactly knew where I was going with that. So sorry to interrupt the podcast, but wanted to ask a quick favor. If you're seeing any value in what we're providing, we'd love it if you could like, follow, or subscribe, whether you're listening on a podcast or watching us on YouTube. One step further is that if you can think of anybody in your community that this episode could help, we'd love it if you could share it to them so we could cast our message further and broaden our audience. Thanks again. Again, in my unelegant, uneducated way of explaining it, you sort of deciphered that. That's amazing. So let's move away from the home. We've spoken about that stuff there. Okay, let's talk about cars. There's a couple of questions that I've got there because we live in Orange County. You know, at the end of the day, there's more G Wagons and Range Rovers than you can throw a stick at. Okay, and it seems to be that that is the car of choice. But that said, is that what type of deductions can people take for their car just in general? We can get into some of the other stuff that is there at this point, but a realtor uses their car. It's essentially like if they're not at home working, they're in their car working. It's their mobile office, so to speak.
Yeah, of course. So my answer to your car is it depends on the situation, but you're
Okay.
going to be able to enjoy all the deductions you can really possibly imagine, depending if you have an entity or just if if you have a Schedule C on your personal return, you're still going to be able to take the benefits, whether that be you can take actual expenses
Mm-hmm.
or mileage. And the mileage is like 58 cents. And then mid year, it went up to like 68 cents, right? It was the
Right.
allowable deduction. I mean, I would imagine that is because our gas went through the roof. I think I was paying $7 for my fancy gas there for a minute.
Yeah, it was expensive indeed. But so as far as what way would you? It would depend on if you're doing a great deal of miles, you should take the deduction of miles. Is that right?
So you get to choose, right? So
Oh, okay.
you can choose. So track your actual expenses. For me, I'm thinking, you probably have a lease, right? Because who in Orange County keeps a car longer than 3 years, right?
Fair enough. Fair enough.
You likely
Yep.
have a lease. You have, your gas, your fuel, your oil, your tires, your car washes, all that stuff. Your actual expenses, or you can take the mileage, right? So you track your mileage the best you can because honestly, I mean, there's even an app like on your phone. Just try it because if you get audited, that is the first thing they're going to go for. So if you just
Got it.
do a general effort, it's going to save you should you ever get audited because it is a nightmare. So just
Yeah.
slap something in there to pay attention to your miles, or at
I've
least
seen those apps, right? Like you just download them and then it essentially basically tracks it for you.
and you'll sleep better at night.
To a degree.
Yeah,
Yeah.
I mean, you really will. But so then you have your mileage, and so you go, okay, well, I drove 10,000 miles, so whatever, $6,000 is my deduction, or my lease plus my gas plus all of that was like 14,000. Take that one. You get to choose.
Yeah. Yeah, okay. So then that leads me to the next thing, is that with the Range Rover and G-Wagon phenomenon that is going through the country, is that this Section 179 and how that works. So from my understanding now, this is not a really this is a vulnerable moment for me, people, is that I've learnt this basically off TikTokers that say you should go and buy a car that weighs over X amount of pounds in order to then you can deduct it all in 1 year. I'm just so unsure of how this works, Anne. What is it?
Yep, that's so funny because, I mean, believe it or not, that is really the case. Um, in the 179, the G Wagon specifically, it's heavy enough, right? So the rules are, so there's Section 179, but there's also Section 168K, which most people refer to as bonus depreciation. And you can actually take both, right?
Okay.
So with the Section 179, you can take, it's limited, right? But right now in the world, in our tax world, in the bonus depreciation, this 168K is always a topic.
Right.
When they're, people are running for this, or they're changing our ways and means people, right? Bonus depreciation right now says that you can expense 100% of basically anything. It used to be only new, but it's not even that anymore. It's 100%. So bonus is rad. Now with 179, there's an issue, right? So bonus and 179, they are similar but different. With 179, you have some limits. And that's where the vehicles, the G Wagons and whatnot come up, right? So the issue is, if you have a vehicle for work that you use more than 50%, which of course all you realtors do, right?
Yep.
You can, if it's under 6,000 pounds, you're only going to be able to take a certain amount, right? So each year, and it changes every year with inflation, with who's in charge of the country, right?
Yep.
Who's our majority of that. So, if it's under the 6,000 pounds, you have a limited amount that they'll let you take, which includes your bonus and your 179. I think it's 19.2.
Okay.
For the first year, and then it's like 10 something the next year and 6 the next year. Or, with the G-Wagons specifically, it's literally, that's why you see it on TikTok. It's because it actually exceeds the weight limit that makes you be subject to those rules. So you could, I don't know even how much they are.
Yeah, like call it 250 to 300 grand. Yeah.
Right. So you can expense the whole thing. I mean, that sounds like one of my clients, big giant touring armies.
Well, so that said, so essentially I go and I buy a G-Wagon. It's $250,000. Do I have to buy it or lease it?
Either way. I mean, no, that's not true. You need to buy it. If you lease it, then we're going to turn around and play the game of what was more expensive, and it's always going to be that. So you would always write off your lease payments on your entity. You would always. So that's really one of the biggest differences, right? Is with, a lease, you do not get the advantage of what we would call accelerated depreciation, meaning I get to take all of it.
Yeah. So let's say I've had a huge year in real estate, and and we're in November, and I know that I'm going to have a pretty big bill next year. Would you say that if I had the spare cash there, go and buy the car, and then let's depreciate it all with that individual year in order to try and save us as much as possible?
Exactly. And so that's one of the differences too, because depreciation, and this is always a great reason why you should check in with your CPA at the end of the year, because they're going to be able to help you with end of the year planning, moves you can make. Ben, go buy a
you reached out to you reached out to me in October. Like last year. Yeah, we were talking about this in October. I saw an email come from you, hey, we should probably catch up, and I'm like, really? Already?
that hurts my feelings. I'm not that bad.
No. But I'm like, it's like, oh, it's that. Oh, right. Oh, okay. Anyway, Anne had to get a little bit more creative this year. There's little differences in a few of the years, but I guess that the thing that, like, we've referred to G wagons and Range Rovers and whatever. It doesn't matter. Like, you could do a truck, like
Do
or
a truck,
as long.
yeah.
Mm-hmm.
A truck, anything like that. Yes, and that, I mean, when we say that, I mean, it really is cars, trucks, vans, anything like that.
Yeah. Yeah, I think
Scooters,
even one
for
of the,
Pete's sake.
I think one of the Teslas actually qualifies because of the batteries, how heavy it is. So,
Could very well. Yeah.
So then there's another thing. There's another thing that I've seen some people talk about, is that they would go out and they would buy the car cash, okay, as an individual. So Ben Brady goes out, writes a check for a car for however much it's going to be, and then I lease it back to my S corporation or LLC or whatever it may be. Is that something that you would recommend doing, Anne, if they had the money, or what do you think?
Just no,
Okay.
because you don't need to do all that. That's too much work. Right. It's your vehicle. Are you the owner of the S corporation? Yes. Put the vehicle in your assets in the S corporation and write it off. So it's just it's one too many steps.
It's like me. It's like me getting the receipts.
Yeah, you're taking another receipt then.
Kelly, you're gonna have to watch this, okay? Because she is all over me. She's all over me. It's like, Kelly, it's my company. She's like, don't care. Get them. I'm like, okay.
I think I'm making your life easier.
Yeah, I know. There's no question. Well, that was happening by default anyway. So let's talk about technology. Like going out and buying a laptop, going out and buying a new phone, going out and buying a tablet. I might need a new camera. I might need a new microphone or whatever, or light it may be for a podcast that I'm doing. Right. All of that is 100% through the company. Is that right?
100% through the company, and you just write it off. It's not even an asset. I mean, unless I believe it's 3,000. I don't know. They change the numbers all the time, right? So I do not memorize that, which I can Google. So, but all those types of things, if they're under $3,000, you just expense it as a, small tool, right, or, whatever it might possibly be. Yeah. You don't. Yeah. Go get that stuff. Buy it. I mean, at the end of the year, depending on how your P&L looks, I'm probably going to tell you to go buy it.
Absolutely, yeah. And then so phone bills and like your cell phone, 100% should be through the company. Like AT&T should, like if you go to AT&T, you should have the company sign up for the phone plan. Is that right?
Yeah, if you can, that would be great. My company is with AT&T, but and it's family plan. We're all on there. My kids are on there. My business partner, all the people are on there, right? But that's a business expense.
Absolutely.
Yes.
Absolutely.
Yeah, definitely take that cell phone, because doesn't everybody just text you now?
Yeah, no question. It's amazing. It's amazing. So my mother-in-law has just moved over to help us with the property management division, right, that we're opening up. And it's funny how she's like, it's amazing how many people like text me here. Like, because in Australia, you don't text. You'll pick up the phone and you'll make a phone call, right? Yeah. It's just very, very different. Where here I had to get used to the way, because I can't spell, read, and write very well. So everyone's texting me. I'm like, oh, that's not good. That's not good. But anyway, so there's another one here, Anne, that like is like fringe benefits and things along those lines that I want to talk about, like the entertainment. Like if you're going to dinner, if you're going to parties, if you're going to if you're buying gifts, like things along those lines, how would that work through the business as well? Like, how does it qualify? What do you like? What can you do? Like, what's too much essentially? Like, you can't write every single dinner that you ever have in 12 months off in your business, or can you? I don't know.
As long as it was at a restaurant and you were talking business, then yeah. And so the IRS says, it needs to be at a restaurant. You can't go to the grocery, buy pre-prepared food, whatever. I mean, they get a little technical in there. And then they also say, oh, but it can't be extravagant. Okay. Define it. It's about as vague as possible, because what do you mean extravagant in OC, versus extravagant in Minnesota? That's just sort of one of those things where it's like, okay, you can argue your way out of it. I remember one client saying, Anne, I'd move out of California, but I just don't think people would take well to my Maserati in Ohio. And
There you go.
and so it's just it's a different life. But yeah, so I mean, if you really are going to dinner and you're talking business, and that's what we do in the service
Yeah,
oriented business, we go take people to dinner, we go out with
yeah.
clients, we do drinks, we do X, Y, and Z. Yes, that is deductible. And in 2021 and 2022, so this tax year that we're about to file, it's 100% deductible
Wow.
meals are versus, and it's only for these 2 years, versus usually it's only 50%.
Yeah, yeah, right. So,
So go
okay,
for it.
that,
Get after it.
yeah, yeah, get after it. Yeah, for sure. Like, no, that's a good point. Like, because yeah, again, I've got, I think
Be
about it in
angry.
the sense of that. Yeah, I just think about it in the sense like if you're going to do a client appreciation event, do it. Like like it's money that ultimately, yes, you've got to make money in order to be able to spend it. I get it, but spending it in a smart way, when it's the entertainment side of it, but then also marketing yourself, like going out and doing some marketing. I'm assuming that marketing's 100% as well. Like if you're going out and you want to go and pay for social media adverts or leads or anything along those lines, that's all 100% right through the business as well.
Yes, absolutely. With marketing. And, one of the things that you did, talk about is client gifts, right?
Uh-huh.
Client
Yeah.
gifts, parties, things like that, right? So client gifts actually is very ticky tacky where they say, well,
Oh,
yeah, I mean, 25 bucks, they want, I mean, so what I'd like to consider, and again, we do have a disclaimer at the beginning, this is not
yes.
tax advice, but I don't know if I'm giving a client a gift, I'm pretty sure I'm advertising my business,
Yeah, right.
right?
Yeah, okay.
That's advertising, that's marketing, and I'm going to put it in that bucket.
Right.
Um,
Okay, gotcha. That makes sense. Okay, that makes sense. That's see again, some creative accountancy, guys, some creative tax side of things really does help you. Now, I want to get into just a little bit of a more like a scenario basis, and like let's say that I'm going to, oh, sorry, before I actually get there, I want to talk about retirement contribution. Now, if I'm a 1099 and I'm just getting 1099 at the end of the year, if I'm an SCorp, which we're likely probably suggesting it would be the best way to go if I'm a realtor, how do I make retirement contributions and what can I make from a retirement perspective? If like, what are the maximums and how does that look? Obviously, it's per circumstance,
mhm.
but what does that look like?
Yes, so there are different types of plans that you can set up, whether it be SEPs, 401ks, defined benefits, all that type of stuff. And so the numbers change. It depends. It
Hmm.
depends on yourself, on your employees, what kind of plan you have, but it is based on essentially your earned income. And there's a lot of avenues, and I don't pretend to be a specialist in retirement. I'm just going
Yep,
to tell
yep,
you,
yep.
you need a defined benefit plan, and I need you to call Alicia.
Yeah, yeah,
Or
exactly. Yeah,
whatever,
Alicia.
but
Yeah,
yeah,
yeah, yep.
absolutely. You need to take advantage of it because to me, I like to put things very simply because I just think simple, but you're going to pay the tax over here.
Hmm.
So you owe $100,000,
Hmm.
or you could pay $90,000 and put the other 10 in your retirement plan. I mean, to me, it makes perfect sense. Do you want to just give your money to the IRS or put some of it away for yourself? I mean, to me,
It makes me angry that people would just actually that like a lot of people with the wrong advice or a lot of people that think it's too hard or a lot of people saying I don't want to spend a couple of $1,000s to go and actually literally just talk to somebody for 5 minutes
right.
that actually can do that. You're literally pissing it against the wall. Like it's for lack of better terminology. I'm sorry, but realistically, you're throwing it down the drain and giving it to a place that you shouldn't be giving it to. That ultimately could be put into a mutual fund in your 401k or wherever it needs to go in your retirement and be worth so much more money. It'd be the difference between being comfortable, not being comfortable in your retirement. Like
Exactly.
again, that I'm not even in the business, and I could automatically just see that you could lead horses to water. You probably end up dunking their head in the trough most of the time and drowning them.
Yep.
You can't make them drink, and like it's it's just little things that take a little bit of effort that ultimately can have an unbelievable gain. So when it comes to them coming over to you and talking from the tax perspective, you would then refer them out to Alicia's, our lady that works in Ira's office, that does all of that retirement stuff. And I know for a fact that she's done a great job with minimizing what we have to pay in tax by maximizing our retirement plan. So that's sort of how it works.
Yeah, absolutely. Because we're going to say like, oh, well, this is the type of, setup you have. What are your facts, right? What is the
Yep.
facts as we would unpack them? And basically then there's just different vehicles to take advantage of
Right.
based on that and based on your employees. And, let's, make it to where you have a profit sharing, right? That
Yes.
basically benefits the owners the most. And there are things that do that, I mean, and
Mhm.
it reduces your bottom line. Like, hey, do that,
Yep.
And the best part too with things like that, when it comes to, your retirement, is it's a deferred deduction, right? So Ben, you're not going to have to pay in for
Mhm.
your retirement until September of 2023, but you get to deduct it for
At
your
the time.
22 taxes, right? So that's one of those cool vehicles that we can take advantage of after the fact. And it's a game, right? Well, okay, well,
Yeah.
you don't have to put all of it in or out, or what do we need to put in order to manage your tax liability at the end of the year? That's the fun stuff.
Yeah. That's the fun stuff. Yeah, no, that like again, it's funny how I don't know if the right word's giddy, but Anne gets pretty excited when when it comes to this type of stuff at the end of the year, or even around now, coming back and going, okay, so it would have been X amount you're going to have to pay, but now it's this based on all of this and like and doing all of that. But that's going to give me another like I want to end this with a bit of a circumstance and just sort of paint a little bit of a picture, and you say what possibly some avenues that could happen. Let's say that I've set myself up as an S corporation, which anybody that's listening can reach out to you and you can point them in the direction and help them do all of that in.
Mhm.
So I guess that the part is that let's say that I've set myself up an S corporation, I've made or I've had $200,000 worth of commissions that have come into my S corporation for the year.
Mhm.
I so from that money that's come into it, pre-tax money that's come in directly from the commissions from the brokerage, is that I should be paying myself a W-2 wage out of that and then making and then getting disbursements. How can you see, or what would you say is the best way to then approach that?
Sure. So it's pretty easy um, with an S corporation. If you're gonna, you essentially that is the rule. You must pay yourself a W-2 wage. All right, which is great because you've immediately reduced your taxable income, and then
Right.
once you do that, you can take distributions. But the concept is with a distribution, you really are only taking the profits and putting it in your pocket. It's that does not change your bottom line because your profit is what you pay tax on,
Yep.
right? So you're just taking some of that, put it in your pocket. You should probably use it to pay your tax.
Yes, yes, yes. So is there a limit to how little you can pay yourself?
Well, it's actually quite the topic
Right.
within the IRS, and so what they say is you need to pay yourself reasonable compensation, right? And
Yeah,
there
it's like
are,
yeah, it's like not extravagant as a term. It's vague.
and also not underpaid too, right?
Mm.
That's also the other thing because like, oh, I'll pay myself $100, but the it needs to be reasonable, and because a lot of people think, well, I'll just pay myself a small wage and then take everything out as a distribution. They're going to look at that and go, that kind of looks like a corporation, and I'm going to turn those into a dividend, and now you're going to pay tax again. That's getting in
Yeah.
the weeds
Okay.
a little bit. I'm getting all excited.
So I guess that to round out this, because there's been a great deal of information here. somebody's listening is going, look, I don't have the right relationship with my CPA. They're not being creative enough. Like, again, we've been very basic on this phone call. Like the intricate conversations that you and I have had over a 2.5 year relationship around restructuring some of the volume of corporations that we have and all of the different stuff that goes on with the different companies and the different businesses and the different liabilities and all of those different things, is that, we came to you from a creative accounting perspective. What would you suggest if I'm a realtor at the moment and I'm like, look, I really need to get this buttoned up. I'm prepared to, really make this a focal point so that I can take maximum benefit of what I'm earning.
Mhm.
Would you just sit down? Would they just reach out to you and just have a quick consultation, and like to get an understanding of the situation?
Absolutely. Yeah, I love doing that, Get yourself organized first
Uh-huh.
and come with, reach out to me and let's set a time. Let's look at what you have. And I can either say, yeah, I can help you, or I can say, your CPA is doing fine, or
Okay.
you need somebody different. Right. And
Right.
I have no problem saying no, because too much work, or if I'm not good at it, I don't want to do it. Right. I'd rather give it
No.
away.
Yeah, that's right. So what would you say is the definition of prepared?
I don't want your box of receipts, Ben.
See, Kelly? See, Kelly? Okay. Kelly, you better be listening.
Prepared means you've got some tax returns to show me. You've got some books that are at least put together. I mean, I understand in the world of everybody else, your books are bad. Everybody's books are
Yeah.
bad. I mean,
Yeah.
unless you have a decent, accountant, bookkeeper like Kelly, who
Yeah.
actually is
Yeah.
very excellent at it. Most people have terrible books, but put
Yeah.
something together, give you some tax returns, and have have a conversation, be ready for a conversation about where we go from here, and then
Yeah.
give me something to look at.
I think that from my own personal perspective, and is that the thing that happened when I came to you, because you were actually our third CPA, right? And realistically, is that the one thing that happened when we came to you was it sort of built a team of other necessary things that we needed. If you couldn't have helped with that, you knew somebody that could, that you'd worked with and that your clients had worked with and that you could vouch for. So I think that for everybody's listening, if you go to Anne, she's the first port of call to a resource in this field of things. So our attorney knows Anne, our life insurance person knows Anne, our retirement planner knows Anne, all from that sphere that Anne has worked in. And I think that that's the really cool thing about what this can create, is a resource that and a network that can be expanded.
And it makes your life so much easier, right? Because I don't have to go. It's not like, it's like playing telephone, right? Hey, Ben, tell Alicia that I need this. And then Ben needs to tell Kelly to tell Alicia, where versus I just go, Alicia, give me Ben's X, Y, and Z.
Yep.
You're completely cut out of it. It's more efficient, and it's, you're doing what you're
Yeah.
supposed to do.
And I've got to say this to end everything out here. People need to stop being tight asses when it comes to their accountants. Like, there is one bill that I have zero questions when it comes to paying. It's Anne's. It's based on the perspective of that that you're getting it back 50 times, in the perspective of like she just gave you the example, guys, is that her reaching out to you and going, hey, can I have this? No, she reaches out to the network that already is helping with that. So first of all, I want to say thank you on our own, Calliston and I's personal perspective, but also thank you for giving us such good sound advice and some ideas for people to think on. I think that this is invaluable stuff that everybody needs to focus on. I'll make sure, Anne, that all of your information is in the show notes so they can reach out on website, email, call, or anything like that. But again, thank you so much for joining us on Rethink Real Estate.
Absolutely. Thank you for having me. It was really fun.
Thank you. So about 75% of our audience hasn't liked, followed, or subscribed to our podcast. It would mean the world to us, and it would help this podcast more than you know to expand our reach if you were to like, follow, or subscribe on any of the platforms that you're watching or listening on. Thanks again.